Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, July 3rd, and then we'll see how things look for Friday, July 5th. Before I get started, please have a very happy 4th of July, Independence Day. I've spent most of my career as an educator, and I really enjoy learning about and teaching about early American history, about the American Revolution or War of Independence, and what really was the foundation of America. At the same time, I love barbecues, baseball, getting together with friends, celebrating the country, honoring the folks that serve in the military. So I hope everybody has a very happy and safe 4th of July. Also know that I do have the SPX Investing Program. It's still pretty much wide open for right now as I'm adding some new things onto the site. Feel free to check that out if that is of interest to you. I do have a link in the description below, which will take you to the site. I also have a link to other videos where you can go back and learn more about the program. There's a playlist on YouTube. There are videos available on Rumble, or you can email me. We can set up a time to talk about this either by email or talking on Zoom or Skype or what have you. Also, I need to explain this from time to time because I do so many different videos and all the videos are rather lengthy. My personal approach is you can't be consistently successful in the markets without really understanding what's going on. And I have so much information that I cover, I break it down into different videos. The other videos that I make available include a weekly video, an intermarket analysis video, deep dive video, and a what to watch video. Those, and then there's additional supplemental videos. Well, all of these, including the supplemental videos, supplement what I consider to be the real foundation or core of the analysis is the daily video that I post every day. Because if we want to see things happening before they actually develop, if we want to be aware of what's going on and what to watch, the other videos are great. And you, even if you have a long-term portfolio, keeping an eye on what's happening day by day by day will help you to avoid being caught off guard for one hand, and on the other hand, enable you to see things before they actually happen. And we try to develop foresight with that instead of looking now and going, oh, I wish I would have went long 5 days ago or a month ago or a year ago. We actually take these things and break them down into the daily video. But because we have to come up with a lot of analysis based on tons of information, that's why I separate this out into different videos. So if you ever come across a video that you're watching and it's the weekly video and you're like, okay, well, what does this have to do with anything? It has to do with the daily video. It all ties together that way. All right, let's go back and talk about what happened right at the open, and then I'll go through the charts. We did have a higher open, and prices rose above R1 at 55.26. So we're getting a little bit more above that 5,500 level. Then we just kept climbing, and we closed at the intraday high. Even though it was a shortened session, we didn't see an awful lot of selling coming in. We didn't go straight up, but we ended up closing at the high. So for right now, based on price, if you just look at a chart of the S&P, things are looking pretty solid. It's when you look under the surface, that's where we have some concerns. But ultimately, we do have to go with price. As I often say, price is the ultimate indicator. We were up 0.51% and we were well below average. Some of that had to do with the holiday, some of it with the shortened day. So yeah, you put it all together and we had a below average volume day. We are positive in the short, intermediate, and long term. There are some concerns, as there always are, but we've been watching these concerns for a while now, and we're wondering if at some point these are going to come into play. And in Friday's session, it's going to be about the employment situation report, probably the biggest economic report. Now, a lot of folks are going to be tired. They might be dealing with a lot of Fourth of July cheer that they're trying to recover from on Friday. But still, this stuff is coming out anyway, and the market will react to that. And then that'll bleed over into the inflation and interest rate scenario. Because of the holiday, and it's specifically an American holiday, this is going to turn into a 4-day weekend for a lot of folks. It's the summertime. People are out doing things. We just want to be aware that there's crazy things that are going on, not only within the US, but across the globe. And I remember the first 4th of July after 9/11. My gosh, that was a shortened day as well. This would have been July 2002. The market was just crazy because there was all this speculation and all these rumors going around that we were going to get hit again. And the market was just freaking out. So, because it's an American holiday, and I hope I'm wrong. I hope that nothing really weird happens, but at the same time, we live in crazy times and where crazy things can happen. So we have to be realistic about it, hoping for the best, but also keeping in the back of our mind that strange things do develop. Some comments. The NASDAQ 100, NASDAQ, and S&P. This is, again, it's like pretty much the same headline here, did close at new all-time highs, and the mega caps are what are really driving the market higher right now. This is pretty positive in my opinion. The parabolic SAR, which was negative for a couple of days, it's actually switched back to positive now. So we have the dots underneath. So that's showing an improvement there. Our list is getting a little bit longer here in the short term, looking extreme. Now, as I always say too, there are two ways to look at this. We're getting extreme and due for a pullback, or this is showing just good solid momentum. We have the Williams percent R, the CCI 14 and 20, the stochastics, which seems to never go away, and the RSI 9. That's the shorter term RSI that we look at. A little bit of an expansion here with the intermediate term list. Standard deviation, we're getting up into that +3 channel now. The rate of change based on 50 periods, this is the second day we've been extreme with that. The Sean trend meter is now back on the list. And believe it or not, the Boom 20, it's not on the list yet, but the Boom 50 is. Usually we see the 20 go extreme, and then after that we see the 50. Well, we've been chopping around so much where the 20 is just kind of, I'm not sure what to do, where the 50 is looking a little more strong based on the boom indicator, and then our more intermediate term RSI based on 14 periods. The scenario hasn't really changed. I couldn't really see much of a reaction to the Fed meeting minutes, so we would have heard about it if there was anything all that drastic. But it looks like if they are going to cut interest rates, it will be in September. Now, that's what the market thinks is going to happen. That's not necessarily what's really going to happen. If you remember back 2 years ago in June of 2022, we had a nice little run up until Chairperson Powell went to, what is that, Jackson Hole. The market was really anticipating things. This was 2 years ago. And then he made this doom and gloom type of speech, and that just sent the market lower. So the market is notorious for trying to get ahead of what's really actually happening. But right now, it looks like if we do get a rate cut, it will be in September. And again, we don't even know if that's going to happen. The dollar was down and interest rates were down. This also helped stocks. We closed at 4.34%, 35% for the 10-year yield, where we had been at 4.44%. We're still inverted with those blasted yield curves. That's also gone on for a couple years now. And even with the up day, we really ticked down. This might have been some hedging going on ahead of the holiday week or weekend. You can almost call this a weekend because it's Thursday, but everyone has to work on Friday. At least the stock market people have to. A lot of folks will be taking 4 days off. So it's kind of like a Thanksgiving type of a stretch here. But we came down from 50 down to 44. So we were right at neutral when we were at 50. Now we're more negative at 44. We're still positive with our trend. The ADX is getting stronger. Now we're getting a little bit concerned about the short term. That's starting to get above 40. Not that we're expecting any drastic change. We just want to be aware of this. The intermediate term ADX is still looking pretty solid. We are positive with the up day, and I'm still keeping the momentum at mixed. I probably could have changed that over to positive because we're breaking out and setting new all-time highs. Here's the big list. This was the big economic report day because they had to cram everything into Wednesday since Thursday were closed. We did get the weekly MBA mortgage applications index. They were down 2.6% last week, last week. They were up 0.8%. The ADP employment change came in at 150. That was weaker than the 163 they had expected and down from the 157 we saw last time. jobless claims came in at 238,000, a little bit more than the 235,000 that they thought, and also up from the 234,000 we saw last time. Continuing claims actually came down. No, they went up just a little bit, 1.858 million from 1.832 million. The trade balance, this is always negative because we're always buying more than what we're sending out. Minus 75.1 billion. They expected minus 76 billion. Last time we had minus 74.5 billion. I don't have a chart of this next one, the S&P Global U.S. Services PMI. It came in at 55.3, the same as last time. The takeaway from this is services, this is not manufacturing, is that we're above 50. So this is showing expansion. Factory orders came in down 0.5%. They expected them to be up 0.3%. Last time they were up 0.4%. This was kind of the big one, the ISM non-manufacturing, which means services. It's under 50, so it's showing contraction. It came in at 48.8. Last time it was at 52.5. Or they expected 52.5. Last time it was at 53.8. All right, here's a slug of charts to show you. And the takeaway from this with the weekly jobless claims is the moving average is going up. This is showing some weakness. This is what the Fed has been waiting for. The employment situation has remained strong. Now, it's still not out of hand. It's not like jobs are just falling away. But the fact that this has been trending higher now over the last couple of months is a little bit of a concern. And the continuing claims are also starting to go up, showing a little bit longer term unemployment conditions for some folks. Take all of that together, we have the red line are the initial claims, then the blue line are the continuing claims, and then in Friday's session, we're going to get an update on the unemployment rate. Here's a bigger look at that same chart just to make it a little bit easier to see. Here are the weekly mortgage applications where we declined after we saw a really big upthrust and then a couple of minor positive weeks. Well, they really dropped off. The ADP employment change is declining. You can see since March, we're positive, but we have been declining with this. And then the monthly nominal trade balance. This is the 3-month average of this, where it's actually declining after it had been going back up. Looking at the year-over-year change, where we look at the imports and exports, the exports are the blue line, that's declining. The imports are actually going up. So a little bit different than what we typically think, where we tend to buy more than we send out to other countries now. The nominal trade deficit just continues to be negative and is getting even more negative. Factory orders year over year just barely above zero and pretty much chopping sideways. Durable goods year over year dropping below zero. Non-durable goods, apparently these are things that are built to fall apart. It continues to go up here on a year-over-year basis, and then non-defense capital goods year after year coming down just slightly below zero. The ISM, where we have the total, which is the blue line, this is falling down below 50 where it had been above 50. That's showing a contraction, but we're also seeing a decline in the prices. And I think it's probably more the prices that the market is focused on currently, because if this is going up, that's more inflationary. Coming down, that tends to be more inflation friendly. Some Isabel Net blog charts, and I just love it when people say arithmetic. It's arithmetic. It's what we took in school. This is the annual real return, taking inflation into account during different periods. We're focusing, the strongest period was from 2017 to 2021, where we saw a really nice run up there. I don't use this to make decisions. It's just kind of an interesting chart to look at. And the periods of extreme market concentration during the past century, where this is what we're really seeing going up. These are the big market cap, big mega cap stocks that are really making things go a lot higher. And then the buybacks continue to be strong, even though we're entering into that blackout period where they can't really do anything while their earnings are getting ready to be reported. And then the odds or probability of a recession, we're kind of just chopping around, but it's coming down from the higher readings that we had been seeing. And then this is, and I have to move this bar here, right here. This is the equal weight S&P 500 compared to the weighted S&P 500. They're both giving us good solid returns, but the light blue here, this is the equal weight index, and it's been underperforming. Then what accounts for the inflation that we're seeing? And not always, usually I make a snide comment that when we get the CPI, it's like, okay, core CPI that takes out food and energy because those are the things that you really need. Well, look at the green area, that's energy, and the blue area, that's food. So yeah, that's why we look at these other things. Now they justify that by saying, well, energy prices and food prices are so sporadic. They can go up and down and all over the place really quickly. Okay, fine. But this is just showing that a large part of the inflation that we are experiencing as individuals is we have to buy more, or it costs us more to buy food, and it costs us more for energy as well. And then looking at the sector, where is money now that we're seeing actually overall money is still going in, but it's really dropping off from what we saw based on the 4-week moving average. But we still have the tech sector. That's the darling that everybody likes. A lot of money going into ETFs. Where we're seeing money coming out is consumer discretionary. And that's been one of the areas that have been rather frustrating because we want to see growth and value doing well, or growth outperforming value. We also want to see discretionary doing well, and it just really hasn't, man. And a lot of that has to do with Tesla. Okay, didn't really find anything on Twitter. These are the charts from the previous session. I just didn't want to spend a lot of time there. Most folks are kind of checking out for the time being. So going to the intraday chart here, we're just ever since Tuesday when we had that little choppy open, we pretty much have been seeing a really solid advance up. The thing that I posted on the website, and I was noticing the parabolic SAR was turning back positive. When I made that post, we were just about coming back to the high set last Friday, which was the all-time intraday high, even though we closed off of that high. Well, we were finally able to break above that and get above R1, and we closed pretty much at the high for the session. So this is looking more solid right now, and it's always a good thing, or more positive anyway, when we end up closing at the high. The intraday, we didn't see an awful lot of action in the futures. We're actually looking more negative, and then it was later on in the day when things started to turn more positive. And this has been positive all along. The intraday chart of growth versus value with the blue line above the red line. We're also seeing an improvement here with growth of value with the S&P. That's showing more strength. At the end of day, we were up with growth where value was down. We were up with the mid caps and down more with the small cap growth of value. So our end of day charts, not seeing any real strength here with the small cap growth to value ratio. Mid cap growth to value ratio is going sideways. This is where we're seeing some improvement, and this is what we want to see, where we see S&P growth to value continuing to go up, showing that growth is outperforming value. This is also showing where growth is outperforming value, but this is one of those disappointing areas. We look at discretionary, which has been chopping sideways. If we've been seeing any weakness, it's been in staples, and that's what's been holding up this ratio between the two. Large cap growth is now setting a new all-time high. We're also setting another all-time high here with large cap versus small caps when we do a ratio. The Wilshire is setting an all-time high. The trend is looking pretty good here. This is solid. The ADX is above the moving average and the green line's going up. So that's looking good. What's causing us some concern is that we're getting above 40 now. Now that's a static number, and there's nothing necessarily saying that we have to turn and stop at this point. This is just when we take notice of this. What we'll be watching is back here on the intermediate term chart to see if this continues to go up and it gets above 40. Now, we can also watch any of these lines, whether it's the green line, the red line, and when any of them get above 40, that's when we just pay more attention to things. And we really dropped off with volume there. Sentiment not really showing a change with the ulcer index, suggesting that there's not a lot of fear. We did get the new reading from Investors Intelligence coming in at 3.73. Yeah, that's high, and you could say maybe a little extreme. We really start to notice this if it gets above 4. And we actually ticked up a little bit on a closing basis with the VIX. Again, this could have been some hedging going on ahead of the holiday, but we ticked up just a little bit with the line chart, and we were down with the bar chart. You can see the VIX barely moved it, but having it up a little bit is not really a surprise. And we did tick up a little bit with the volatility of the VIX with the line chart as well as the bar chart. And we haven't quite rolled over yet with the momentum as measured by the MACD. We're going down with the VIX, but not enough for this to really show that we're heading down with more conviction. And I don't know what to think about the equity put call ratios. It seems like this chart updates and it's the 5-day chart, and I still am waiting for the 1-day chart. So take this for what it is. This had been going down. Now magically this is turning and starting to go back up, and that's more negative. Could be some hedging. We ticked down a little bit, but we're still getting a very high reading when it comes to volatility risk premium. So that's contradicting what we're seeing with the actual VIX. And this is another contradiction. We declined with this fair gauge where we went up with this other fair gauge. All right, then this is where we're seeing some negative divergences. We look at the advanced decline line based on price, really didn't move. We're setting all-time highs with the S&P, and this is actually showing a negative divergence here. But when we look at this based on volume, yeah, this is still looking pretty positive. And saw a little bit of an expansion of new highs, really no expansion of new lows, but we're rolling over now with our 5-period. We're still positive. We haven't quite crossed below the moving average, but when we look at the 10-period, we are declining. And we're seeing a mixed picture here. In the short term, the blue line, we're below zero. With the red line, that's intermediate term, that's above zero, but nothing too drastic there. And then looking at accumulation distribution, we are going back up. We're starting to get further above the moving average here. So that's looking good. But I just arbitrarily put this 100 on top and a minus 100 on the bottom. When we get above this level, that means that we're getting pretty far away from the moving average. And sometimes that can suggest a reversion back to the mean. But it doesn't mean right at this level. We could go above this and actually look even more positive than we are now. But this is still a little bit of a concern. The chicken money flow, it's positive, but the red line's going down. But the chicken oscillator is continuing to go up. So that's positive. We're looking good here with the NYSE cumulative advanced decline line. That is going up above the moving average. We're also bouncing up and continuing to bounce up above the moving average with our regular NYSE advanced decline line, as well as this other NYSE advanced decline line. We look at the common stock on the NYSE based on price, not really doing, we're just kind of chopping around, seeing a little bit of an improvement here based on volume. This is where we're seeing something negative and positive at the same time. The S&P setting positive or all-time highs, but we're just chopping around based on price with the cumulative measure of the advanced decline line. Where we're seeing any strength is with volume, and that could be going into the big mega caps, and they're the ones that are really holding volume together for the present time. So a little bit of an improvement when we look at the S&P and compare it to the NYSE advanced decline line with the red line going up, but there's still a negative divergence here. In more solid environments, we want to see the red line at least matching what the S&P is doing, if not actually outperforming. These advanced decline line studies not really showing any massive improvement here. We're still below the moving average with the NYSE common stock, right on the moving average with the S&P, below the moving average with the mid caps and the small caps. So our short-term chart, we're coming right up to this previous pivot point here, which may act as overhead resistance. And we really dropped off with volume. Not a surprise there. We are still extreme positive with the Williams percent R. The CCI 14 is extreme. And now we have another new addition, the CCI 20, a little bit longer term version here. We're extreme with the stochastics in the short, intermediate, and long term again. But we're hanging in there on a trending basis. The double and triple exponential moving averages based on 20 periods, we're getting back above the lines. That's showing more strength in the short term. And we're pretty much flat to slightly going up with the 20. We actually declined a little bit with the 50, and we're flat with the 200. The S&P setting an all-time high, and these moving averages are flat to declining. Not a real vote of confidence right now. The force index, though, is still positive, and we're above the 20-period moving averages. So when you measure trend using these moving averages, we are still solidly positive. We're getting up into the +3 channel with the standard deviations chart. That's extreme right now, but we could stay up there for a while, which may suggest good momentum. The boom indicator, we're not all that far away from the 20 period, but it's the 50 period that's starting to look extreme now. Now, we could go up more than this. We just note this when we start to get to an extreme reading. Intermediate term, the balance of power is going up and positive, and we're switching over to the darker blue again with the go, no go. So that's turning more positive. The highest high value, we're getting up to the blue line. That's positive. This is still a little bit of a concern. We're declining with the TTM squeeze, and we still see the darker shade of blue here. And then the 50 period is showing some improvement too with our double and triple exponential moving average study. We're getting back above the red line. The red line's above the blue line. The red line's the triple, and it moves faster than the blue line. So this is still looking pretty solid. The ease of movement, just not really doing too much, but it's still positive. The Arun is looking more positive, and we're above zero, so that's positive as well. But this is where we see another negative divergence. The S&P McClellan oscillator didn't really change all that much, and it's still below zero, so that's negative. So the summation index based on price is negative. Now, here is a potential sign of hope. The summation index based on volume, which is a completely different indicator. The two indicators are calculated in a different way. It is starting to turn up. Could this be giving us some foresight to things getting better? We're not seeing it yet based on price, even though we're setting all-time highs with the S&P, but we are seeing this turn up a bit. Be aware of this, though. Sometimes this has led us astray. It's given us some false signals. We just want to know about this right now. Now, when we look at the broad market, though, the NYSE McClellan oscillator, it was just barely above zero. After Tuesday, well, after Wednesday, it's looking a little more positive. So with the summation index for the NYSE, we're just barely starting to turn back up based on price and volume, even though it's very hard to see. Swenlin trading oscillator, still negative based on price, but improving, still positive and looking a little better based on volume. A mixed signal there. The momentum, we're pretty much still right on top of the moving average of the PMO. We're declining, and on the moving average based on price, we're still negative and trying to just barely turn up here based on volume. So a little bit of an improvement with the PMOs that are rising. The buy signals are declining, and the PMOs above zero are also declining. We're still positive with the Elder's Impulse system for the S&P. Here's the big one. We had 2 days with the dots on top with the parabolic SAR. We have now switched to the dot being underneath. That has turned back positive now. The slope oscillator continues to decline. We're still above this green line, but this is looking more negative from a momentum basis. And the MACD is coming right back up to its moving average. So it showed a little bit of an improvement, but has not turned back positive. So the slope is going down. We're still going back up slightly with the TSI. Those are our short-term oscillators. Back up to the moving average with the MACD, turning up a little bit with the PMO, coming back up to the moving average with the PPO, coming back down and hitting their moving averages with our longer-term oscillators, the TRIX and KST. We're still above all the moving averages here, so you cannot deny that. The bullish percent index really not showing any strength right now. It's positive since it's above 50, but we have, here we are setting all-time highs, and this is barely moving, and it did see a bit of a decline on Tuesday. We're turning just a little teeny tiny bit back positive with the NYSE bullish percent index. We're looking a little more solid here with the NASDAQ 100 bullish percent index. The money flow is still below 50 and declining, where the ultimate oscillator continues to look more positive. The vortex, green line on top, starting to show some improvement here. The RSI 14 and the RSI 9 are extreme positive. Because of the up day, we are advancing with on-balance volume and above an advancing moving average. But when we look at the stocks inside the S&P above their 20-period moving averages, it's still below 50 and not really improving. So we're not seeing much of a change here with our 20-period study. We're still below 50 when we look at those stocks above their 50-day moving average. We declined with those stocks above their 100-period moving average, and we're below 50. And we declined with those stocks above their 200-day moving average. This is not what you want to see when the S&P is setting all-time highs. The Copic curve shows that momentum is negative. The Pring bottom fisher is still generating a buy signal. We're starting to get extreme again with the Sean trend meter. And here's the rate of change for the last couple of days. We're above this red line. Now, there's nothing magical about the red line. We just want to notice this when we get to this level because sometimes this might point to exhaustion of the market. This is still negative here. When we look at the broad market and take a 5-period moving average of the highs minus the lows, we are still getting a negative reading, minus 100. This is positive. With the weekly chart of the S&P, we're still above this R2 level and starting to get a little bit further above that line. So that's longer term positive. And we're starting to break out with this fib extension for the S&P. This was a concern. We came up to this 50% extension level based on the low that we set back in October and then this high that was set right at the end of March. So this is breaking out of previous resistance. When you look at the different trend type of charts that we look at here, the Heiken Ashi is positive, and the Kagi has now turned back positive. It spent a couple of days red. Now it's turning back to black and pointing up. The Renko chart is positive. The 3-line break is positive. And then we're still not really seeing a lot of improvement here. The 150 and the 200 continue to really negatively diverge from what we're seeing happening in the S&P. We are negative with the mid caps in the short term. All the other time frames and indexes that we follow are positive. We're negative with bonds based on price in the short and long term. And now the dollar has been under some weakness and is seeing a short-term downtrend. No changes with the decision point scorecard. Lots of blue and green here. We did see discretionary give a BPI crossing below 50, but we have the S&P setting an all-time high, going about 5,500. Canada had a pretty good day, getting above 22K there. The NASDAQ setting an all-time high, discretionary looking a little bit better. The NYSE bullish percent index, that's the chart that I showed a minute ago. That's a little bit more positive. The euro is showing a little bit of strength. It's having a MACD crossover when compared to the dollar. I'll be going over that in the weekend video where I look at different currencies. And we had tech and materials and discretionary doing the best. The only sectors that were down were real estate, staples, financial, and healthcare. And together, these typically are more defensive areas. We're still looking positive with this. The NYSE new highs minus the new lows, we're getting a reading above 0 again. And we're seeing a little bit of improvement with the S&P to the equal weight. But look at this. This ratio just continues to go up. We're getting to nosebleed territory that we got back in 2020 after the big bounce back up from the COVID plunge. I don't know. There's going to be people that are going to try to read something into this, but at the same time, we just want to be aware of it. Are the big mega caps just getting too out of hand when compared to the S&P equal weight? It's happened before, and then we chopped around for a while, and then we saw this going down as 2021 came in. So that this doesn't necessarily mean things are negative. 2021 was a very good year for the market, and we saw this ratio going down as we saw the broad market participating. It was 2022 when things were turning more negative. The Dow, not all that much, down slightly. There was it United Healthcare, I believe, came out with something that the market didn't like, but we're still above the 50-period moving average, and this pivot point is right at the 50-day moving average. We are neutral with the diamonds after being positive with the Elder's Impulse system. The NASDAQ, this is encouraging. We broke out above this pivot point. Now we have another pivot point. That's always going to happen here. We may break out above one, and there's always another one looming ahead. And we're seeing that same thing here with the NASDAQ 100 above this pivot point, but we do have another pivot point above current price. But we are positive with the Elder's Impulse system for the Qs. The momentum is trying to turn back positive here, not quite back above its moving average yet, but showing a real improvement. And we're also breaking out above these fib extensions. This is a 38.2% extension from the low set back in October and then the high that was set back in May. So this is breaking out above these previous price levels, and that is positive for the Qs. The small caps, not really all that much, still underneath their 50-day moving average, but they still remain positive with the Elder's Impulse system when looking at the small caps. When we look at the Russell 2000 small caps, just a little bit above 50 with the RSI, we're below the 50-day moving average, even though we're in a longer-term uptrend. The momentum is trying to show some improvement here, but not an awful lot of conviction to this point. And the mid caps just kind of do, just bouncing around underneath their 50-day moving average. And they've gone from being negative to neutral, though, with the Elder's Impulse system for the mid caps, setting an all-time high with the total U.S. stock ETF. Apple setting another new all-time high. We have Tesla really been up. Was that 12, 16% in a couple of days? I mean, that's a pretty good run. We're above the 200-day moving average. And if this can keep going up, that will help the discretionary sector, which is what we want to see if we're more positive. But this will also eventually turn back and be a golden cross if we can stay above both of those lines. Nvidia was up 4.5%, still one of the most darling stocks of all these days. Microsoft setting another new all-time high. Meta, not an all-time high, but was up a little bit. Amazon was down after seeing a little bit of profit taking there. Google, I believe that's an all-time high there. And Netflix was also up almost 0.5%. So these are the real big stocks. Maybe I'll start including Broadcom as a chart on here because that seems to be drifting in as one of the Magnificent Seven. And there's even been some talk of let's get rid of Tesla as a Magnificent Seven stock and bring in Broadcom. Just that's what they like to do. Just change things to make them look better. The FANG index is setting an all-time high again. The financial sector was down 0.33%, but still above its 50-day moving average. And we're still going down with this ratio, the staples to tech ratio. That means staples are underperforming. And in a more positive environment, that's what we want to see. The dollar is still in an uptrend. Now, it's going to show up being up here because it's still continued trading, even though the U.S. markets are closed now. But we're coming down into the lower 105 range. And when we look at the S&P 500, that's in red versus the world index, that's black. We're kind of more neutral with our correlation based on the short-term 10 periods, where we're still declining with the longer-term correlation. Looking at the staple sector, still battling around its 50-day moving average, seeing a little bit of an improvement with the momentum, but still negative with the relative strength ratio. Utilities were up 0.6%, coming back up to their 50-day moving average. Also seeing an improvement with the momentum and turning back up with the relative strength ratio. Still above the 50-day moving average with real estate, but pretty much chopping sideways. Momentum and relative strength are showing some improvement as well. Also improving with momentum and relative strength, but cannot get above its 50-day moving average for the energy sector. We did decline with the 10-year yield, and that really helped stock prices. So we were back up again here with the 10-year based on price. Still looking at a soft landing scenario if you judge that based on this chart here. And we're still declining when we compare bonds with stocks. That's also what we want to see in a more positive environment. We're coming back down a little bit here, but we're just kind of bouncing around. When we look at cash versus the 3 to 7 year bond, we want to see this go down and keep going down and drop below the moving averages and actually see a death cross here for this to be more positive. When we look at the S&P 1500 and compare it with short-term bonds, stocks are still outperforming. Another broad market measure with 3 to 7 year bonds virtually unchanged, but still looking solid. Tips, these are Treasury inflation protected securities. This had been a concern and we were really going up. We came back down slightly in Wednesday's session. And we're just chopping around in the rainbow here. When we look at 1 to 3 year bonds and compare it with 3 to 7 year bonds, we want to see this decline to be more positive. The Qs are outperforming 3 to 7 year bonds. The tech sector is also outperforming 3 to 7 year bonds. This is a concern. Home construction to 3 to 7 year bonds is coming down. We're wondering if this 250 period moving average will end up providing support for this ratio. The Eurozone still kind of bouncing around, and they still have some elections that'll be coming up this weekend in France, which may add to some of the instability. But this is right inside the rainbow right now when we compare it to 3 to 7 year US bonds. And we're seeing an improvement here with the Qs to S&P, actually an improvement with discretionary to the S&P, and large cap growth is really improving compared to large cap value. So these are looking better. We want to see the discretionary moving average turn back up and see more follow through here with that ratio. So with the large caps are looking better, not much with the mid caps, and coming back up to the moving average with the small caps. So it's the large caps that are continuing to control everything. Big surprise there, huh? 19-day advanced decline ratio, we're negative based on price, we're positive based on volume. The S&P to utilities ratio continues to go up. That's positive for the S&P. The Staples to S&P ratio is going down. That's also positive for the S&P. So what's our outlook for Friday? We are still positive. There's not an awful lot to really change here. We're just seeing the last things that have been developing over the last few weeks. So, but we're positive. You can't deny that part. But we're seeing these negative divergences and not some real internal strength right now, and possibly even some weakness that could be developing. We're going to get the unemployment situation report as well as the ISM non-manufacturing, that's services, that'll be coming out. And then all the geopolitical things. And I've added the French election here just because that's coming up. And then whatever fallout that may be, positive or negative. And then the US election, that's what everybody's talking about now. That's kind of a fluid situation as well to see what's going to end up developing in that regard. And then we'll be finishing out the week on Friday with our economic calendar. Here is a further breakdown of what will be coming out on Friday. Seasonality, July 5th tends to be positive across the board with the Dow, S&P, and NASDAQ. So that's going for the markets. And we're seeing kind of some positive seasonality here with the green dash line during an election year for July 5th. Friday is one of the more positive days based on what happened in 2023. And I'm probably going to throw this over to the weekly video now. This is just a longer term look as we're finished with June going into July, where we tend to see a longer term uptrend over the summer months. And according to this lasts through September. And then the first part of July, I'll probably keep this here because once we get beyond this window, I'll probably take this chart out. But near the end of June into July, this is when we see a mid-year rally for the NASDAQ. They call it Christmas in July. But we're getting kind of far away from what typically has happened on an average basis. So at some point, we're wondering if there's going to be some kind of reversion to the mean. And then we look at the election year, and I'm going to throw this over to the weekly chart as well. We've got a 50-50 split for up and down with an average return of 0.7% for the S&P. This is a new chart, which I'll probably also throw over onto the weekly side, because we have the first half of July, which looks really positive, and that's where we're at right now. And then the second half, it's positive, but really trails off. And then we take the different ways of looking at July, and they all end up being positive, but the election year ends up being the least positive. And we see a nice little bounce here from 1928 up till now during the fourth year of a presidential cycle, where June, July, and August tend to be positive. And this is a newer chart. July is the best S&P, NASDAQ over the last 21 years, where we see good solid returns according to Stock Trader's Almanac. So the warning signs, we're still keeping an eye on those defensive areas. They're just not really breaking down, but they're not really showing any real strength right now. We are concerned about the weakness that we're seeing with the advanced decline lines. The growth of value for the S&P, it's actually doing pretty good, but not when you look at the mid caps and the small caps. Discretionary to staples, again, not really showing any leadership there. The 5-day equity put call ratio is going up. The S&P McClellan oscillator, as well as the summation index, they are both negative. The Swenlin trading oscillator for the S&P is negative but improving. Our oscillators are turning more negative. The money flow is negative. The Copic curve is negative, and we could be seeing a cross back over, but we haven't quite switched with the momentum of the NASDAQ 100. And then we have our smart indicators here. I call them smart because it's the smart money. Accumulation distribution, that one's looking pretty solid right now, but maybe a little too positive. Where the Chaikin money flow, it's declining and the moving average is still going down, but we're looking positive with the Chaikin oscillator. Parabolic SER, this has turned back to positive now, but the NYSE McClellan oscillator and summation index are positive. So we have the S&P negative and the NYSE is positive. Bullish percent index for the S&P, we're above 50, but it's just not showing any real strength now. And the NYSE bullish percent index is just barely crossed back above 50. The ultimate oscillator is positive. The vortex is showing some improvement. The Pring bottom fisher is generating a buy signal. The financial sector is positive, and the bullish percent index for the NASDAQ 100 is positive. So our conclusion, we're now positive, but this weakness is still there. It doesn't seem to be going away, and we're not seeing an awful lot of strength other than being confined to a few stocks. We're waiting to see if the broader market is going to be shifting over and actually looking more positive. In the short term, we are positive, but our list is getting a little longer at extreme positive. We're also seeing a little bit of a lengthening of the list in the intermediate term, although we're still positive there. This is where the weakness and lack of strength is coming from for the most part, where we're still positive in the long term, even though we're seeing those longer term negative divergences with the moving averages. Thank you. Again, I want to wish you a very happy Independence Day, and I will talk to you in the next video.